Good day, everybody. My name is George Evans with Convergence, and I want to welcome you to episode 24. It's actually our 2-year anniversary for doing this podcast, 24 straight months, and I'm really delighted today to have some terrific guests with me. A great client of Convergence, Battea Class Action Services, and I want to welcome two guys I know now for some time, one a lot longer, but I want to welcome Michael McCreesh, who's the president, and I want to welcome Bob Donahoe, who's the senior vice president responsible for business development globally for the firm. How are you guys?
Doing well, George. How are you?
Doing
Thanks for
everything
having us,
good?
George.
Yeah, appreciate you guys spending time with us today. So we're excited to have you, and I thought what we could start with is first, I'd really like to hear just a little bit about you guys, right? Kind of your pedigree, kind of your backgrounds, and then we can move so our audience kind of knows you guys, and then we can move into a bit about the firm. So, Michael, why don't we start with you? A little bit about your background.
Sure. So I spent 25 years at Goldman Sachs in various roles, mostly within the global markets division, ending up global head of commission management, which is kind of the payment for research mechanism. And I joined Battea in September of 2019, kind of an effort to grow the business a bit, bring awareness to it. And it's a fascinating business. So I've been excited to have been here for now 3.5 years.
Yeah, terrific. And Bob?
So I joined Battea 10 months ago. Prior to that, my background was really in the fund administration business. I was with a firm back in the late 90s called Hemisphere Management. We were acquired by Bisis, which is where you and I got to know each other, George.
That's right. Yeah.
Bisis was then kind of parceled out in bits and pieces. I went to the part that landed at Citi, left Citi, went to Goldman Sachs, and that's where I first met Mike. So we saw each other quite a bit on the prime brokerage floor. Goldman sold the book to State Street, was with State Street for a number of years, left and joined HedgeServe, and then reconnected with Mike while I was at HedgeServe, and here I am, and happy to join. So
Yeah.
it's a nice change.
Well, it's funny, right? You think about how you meet people. So back in the good old BISIS days, right? People never knew BISIS stood for the Bank Information Systems Company, which really didn't represent what the heck BISIS did, actually. And then Mike and we met in a taxi in the Cayman Islands, believe it or not, right? And so it's funny. So let's talk about the business. May not be a household name for everybody, right? And I'd really like you guys to kind of give our audience an overview of the firm, and take your time. And I want to make sure people know what you guys do. I mean, certainly, I know that you guys are, kind of experts in really kind of all stages of settlement claims, that have to do with antitrust, securities, litigation, et cetera. But you're going to do a much better job than I am talking about the business. So why don't we give our listeners an overview of the firm, what you guys do?
Sure. Mike, want me to go first?
Sure.
So we'll let the new guy go first and see how smart he is. So just a bit about Battea. So we're a privately owned company. We're headquartered here in Stamford, Connecticut. We've been in business for over 20 years. We have approximately 100 employees. We've got roughly 900 clients located around the world. The vast majority of those clients are hedge funds, but we also service banks, asset management companies, pension plans, endowments, and family offices. In terms of some high-level volume over our history, we've handled over 3 million claims, so we've got quite a bit of experience in the space, and we've never missed a filing deadline. But specifically, what does Battea Class Action Services do? And a lot of times when people hear the phrase or the term class action services, they think lawsuit, they think, lawyers chasing after companies with, litigation, etc. That's not the side of the business that we're on. Where we're focused is on the class action settlement filing. And so sort of the life cycle of a class action lawsuit, Somebody may feel that a company did something wrong. Maybe they falsified their financials. Maybe they gave misleading statements on an investor call. Could be, for example, everybody knows the Volkswagen emissions scandal where they falsified the records. So a class action lawsuit is launched. It goes through, starts out in the investigation phase, pulling together information to determine if there's a case. It's then put in front of a court, sits in the pending phase. Roughly 50% of these cases that sit before the courts get thrown out, but the other 50% will move forward. Many of them will settle out of court. Some will go to court. Let's just assume settles out of court. The company agrees to a penalty, let's say $100 million. That $100 million is put aside and is now referred to as a settlement fund. That fund will be paid out in its entirety to eligible claimants. And it's important to highlight that because not everybody is aware of that. And sort of historically, only a third of the eligible claimants have actually file for the claim. So what that means is those that do file could potentially get 3 times or more what they're actually entitled to because that fund will be paid out.
Meaning because the other filers didn't file,
Correct.
or potential filers
Correct.
didn't
So-
file, so the pool's bigger.
Correct. So if you're a long short equity fund and you hold, I'll use a case that's already settled, Twitter. If you don't file and one of your peers does, they're taking your money. They're taking your alpha because they filed and you didn't. So yes, it will be. It will be.
And we'll go back. It's a good explanation of the firm. How diligent are people, Mike, about filing? I'm just interested in kind of your view of, are you seeing people getting, the trend is better, the trend is the same, the trend is worse? Like, we all sit here and think we live in this litigious society, so everybody be filing like crazy, right? But maybe it doesn't seem like that's the case.
Yeah, I think the arrow is up, and that's a good sign. Since I've been there, I think that the arrow's ticking up, the awareness is out there. And the thing I would say about us is I always equate our firm as kind of the clearing business for class action lawsuits, right? So you think about the trading business where I kind of grew up. The clearing side, they're not involved in the trade, but they're making all of the things happen after the trade. That's how people should think about us. We're not involved in the lawsuit, but we're making sure that everything kind of is handled on the back end. And the odd thing about our business is, to me, the whole selling process is about getting in front of a prospect and then selling them the value proposition. This business, I can tell you, throughout in my career, it's the hardest to get in front of a prospect to really have their attention to what this is. But once you do that, explaining the value proposition, it's the easiest sale I've ever had.
So it's just getting through the door. Yeah.
Right.
Yeah. Finishing up on Bob, anything else, Mike, you would add about just overview of the business for our listeners before we move to some more pointed questions?
I would just say it's a complicated business when you get into the weeds. It's all that we do. And you would say, well, is that really, does that take a whole firm? And it really does. There's such complicated suits, and it's important for people to know we're not conflicted in any way. We just do this. And we're all about finding dollars for our clients. And at the end of the day, that's kind of the main goal. If a client wants to have us service their business, they should want results, and that's what we're all about.
Yeah. And your model, you're a pay-for-performance model too, right? For lack of a better term, is that how it generally works?
Right. So that's one of the, we'll get to the kind of the myths, and that's getting through that first wall, is that one of the assumptions that a lot of people have is that that this is another bill they need to pay. Here's another expense that we need to add, and the fact is, it is not. It is contingency based, and I like to say, you add a new P&L line, right? You call it Securities Class Action Recovery. It's the only P&L line, or one of the only P&L lines, that will never go below zero, right? Because if nothing is ever recovered, it'll always be zero.
Right.
If $1 is recovered and the contingency fee is 15%, you're getting 85 cents on the dollar. You're continuing to do that. Incentives are aligned, and then there's never going to be a bill at the back end, right? So it's really a perfect storm in terms of a P&L.
Yeah, I mean, there's really no downside kind of for the educated buyer, to your point, right? Like, this is about, we've all been involved in selling, and sometimes, selling is a big part of selling anything is educating your buyer, right?
Yeah, and as Bob mentioned it before at the top, some of the key myths, the one I just mentioned about there is an expense, right? That's one. The second is that they'll be named in the lawsuit, right? And the fact is, for jurisdictions like the U.S. and Canada, which make up a lot of these of the population of these cases, unless you're the lead plaintiff, which tends to be one of the big pension plans, your name is sealed. Bob mentioned all of the different types of clients. I think if that was not the case, quant funds, hedge funds, you name it, would not be involved. So that is a myth that's out there that once debunked.
Well, I must say, I probably believed that also, right? That
Right.
you would just think you're named once you file, right?
No,
And
and it's
so
important.
that's probably a huge point to people need to understand.
Yeah, it is a big point to bring up, because the number of prospects that I've spoken with, one of the concerns they've raised is, hey, we build relationships with the management teams of these companies we invest in. We don't want them to see us filing. Well, there's two sides to that. One, if you're filing, it's because you were harmed, whether they admitted guilt or not. Something happened to that stock, bond, option, currency, whatever price, and you're entitled to a piece of that settlement.
Yeah.
Fund. And then by filing, because you're a part of the class, you're anonymized. I know that's an SAT word, but you're anonymized, and the management team will never know. It's sealed by the courts, so you can file confidently, knowing no one will know how you did.
Yeah, and I'd add to that, and Bob had mentioned it before, the entire settlement gets paid out. So one of the other myths is people say, well, I don't think it would amount to much. And I think there's a view that the monies owed to them or their investors somehow will go back to the settling party, and that's not the case. So when you kind of get through that and say, well, actually the money owed to you is going to get paid, it's just getting paid to others who file, that generally is something that drives people. And I'd say the last thing is that there's work, that the feeling is there's work to do, right? And obviously, Bob, you come from the fund admin side, so we work with all the fund admins. So to get that data on a severe lag, because it's not a trading business, these things are not sensitive to time, getting that data through an outside source is generally what happens. So I kind of always end the myth conversation with, just imagine we're in a room, there's a bag of $15 billion sitting over on the floor over there. And if I told you that you wouldn't be, you wouldn't be, made public to go walk over and get your funds, you didn't have to do anything because the fund admin would send the data. You'd get 85 cents of every dollar that we collected for you. How many people would say no? And the answer is zero, right? And so if you start from that premise and then work backwards, most often when we get to that point and get over those humps, people say, well, why wouldn't I do this? And that's the conversation that we like to have, because you hear this, and Bob had mentioned before, people think litigation finance. Oh, I'm investing in this suit. There are those things out there, but that's not what we do. And that's why making this aware as to what it is, it becomes such a simple proposition, and it's really compelling. There's a lot of money out there.
So
I mean, I was going to also ask, when you say go into a hedge fund, who are you targeting specifically? Are you targeting the CFO, the CCO? I mean, who tends to be your buyer typically, say, in a hedge fund?
Yeah, it's typically the CFO, COO, or CCO.
Okay.
It's depending, as you know, hedge funds vary in size and the size of their C-suite. So it's typically CFO, CCO, or COO. And a great example, touching on some of the things that Mike had hit on. So one of the first clients that I brought in after getting here, I knew him from a previous life, and I reached out and filled him in on what I was up to and what Battea does, and asked, what do they do? And his response was, we don't do anything. There's no money in it. Well, I had a report in front of me and I was able to prove him wrong. And I pointed out that actually looking at your portfolio, your 13Fs, our claims engine database, which houses all class actions and antitrust cases on a global basis, there's actually 31 cases out there related to names in your portfolio. And I walked him through a bit of that. He then asked, well, what does it look like for our fund? And I gave him some numbers, and his response was, that's real money. Let me talk to the partners. Give me a couple weeks. I'll come back to you. 30 minutes later, George called me and said, send me an agreement. We're in. And
Yeah. So I mean, so you have the ability, because you take a 13F report from a hedge fund. You know what they're holding, and you could actually go in theory, and monetize that discussion with them before they even sign the dotted line, right?
That's what we do. It gives us a rough ballpark. And then taking that story to the end, they signed up with us. The timing was right. And just before Christmas, we were able to send them a distribution that had come in, and it gave them 3 basis points of non-investment alpha right at year end that they weren't expecting.
Wow. Yeah, that's real impact.
Yep.
Yeah. That's a great case study, which I'm sure you're out there using, right?
Yes.
3 bips.
George, what I would add to that is that, and I also say those are the right people to talk to, but for us, it's the best relationship, right? It's if there is a relationship there, they're going to be more apt to engage in the conversation,
right?
And that's very valuable. Like I like to say to these people is that, you deal in hard alpha. Right. When I was at Goldman, Morgan Stanley, Bank of America, Credit Suisse, they're all great. Right. We had to be a little bit better. It's very difficult to get that trade. If you're a hedge fund, you want to get those dollars. All your competitors are very good. Right. They're professional people, very good. You have to be that much better. Right. So that's hard alpha. This is easy alpha. It's very complementary. And when you kind of put it in those terms, and to Bob's point, you add 3 basis points to NAV in that example at the end of the quarter, end of the year. It's a great thing. And the other piece of it is, when we deliver those dollars, not only is there not is it net of the total, but there's no invoice, right? So there's no accounts receivable, accounts payable on the client's books. They don't need to do anything. They're getting a wire, and they just put it into the P&L.
So it's really about getting in and educating them, and then putting that business case in front of them. Maybe not a fair question. If you don't know, that's fine. But I'm just curious. Like in a typical year, and I don't know if there is such a thing, how much money gets forfeited? What's the dollar amount that doesn't get claimed? And do you have any general idea of what maybe even the bookends of that?
Well, I think, wasn't it $4 billion, I think, last year that was distributed?
Yes.
Right. So if you think about what's 60% of that, right? So that's
right.
the amount.
$2.5 billion.
Yep.
Yeah.
So $2.5 billion went out to other people, those that did file.
Right. Yes.
Wow. So that's a big number.
Yep.
Yeah. Interesting. Well, listen.
The
so
other way to look at
little...
it too. So based on our operating history, we've done some stats like a case study, and just simple terms, a $250 million hedge fund that turns their portfolio just once a year, they could expect to get 3.5 bips per year from filing for class actions. If they're a $2 billion fund and they only turn their portfolio once, it could be 8.5 bips in easy, as Mike put it, easy non-investment alpha.
Yeah. I mean, that's significant alpha, right? I mean, it really is. So shifting a little bit, and I think we've covered a lot of this, but I did want to talk a little bit about the value proposition, which I think we've explored a bit, but if there's anything you want to add to that. But I think I'd relate it to my second question would be, how are you different than the handful that's out there? I know that, for example, an FRT and others are out there that do this. So kind of value prop differentiation, right? I think now our listeners have a good understanding of the nuts and bolts and why this makes sense, and there's no downside. But now they have a couple choices. So why pick you guys?
So
right, I'll start with a high level and then turn it over to Bob for a lot of good detail. I'd say that when you think about the filing public, if you will, like there's people who do it themselves, right? And generally, they're going to deal in the cases that they're aware of, right? But it's really hard to do that as something that is one of your 7 things to do, right? So you have those. You have other businesses that are complementary, so like some of the proxy services do this, but they do proxy, right? So that's competing for resources, and I think if we're going to say where is the differentiation, there's not one sole focus, and we've seen where that results in different outcomes. And I think when I go to the pure plays like us and an FRT, right? I think where we on a high level, we think about the process in 2 parts, and I think a lot of other people think of it in one. And their part is getting the filing in, right? And that's great. But the part after it's filed to where the dollars are distributed is kind of the back end of it, and that is crucially important. And that's where we focus. All the people that we have employed, which I think is a differentiator, they're all financial markets people, right? And that is a big key when you get into some of these cases where not everyone knows what a forward is or things like that, right? And talking that language and having those relationships with the clients, with the claims administrators and those types of people is very important. Challenging the figures that are out there with our own figures, things like that. So I'd say the full process, I think we're second to none in terms of employing that practice. There's a lot of filing, but after the fact, things don't happen. There was a case recently, and then I'll hand it over to Bob, that I think, kind of has the mic drop, right, for differentiation. A couple $100 million fund, 83% of all of the filings were not sufficiently filed, meaning they were rejected and not rectified. We had a small percentage of the clients in the case. We had over 53% market share. So by definition, if you think about the math, that tells you that we challenged successfully, we got our filings in, and since 83% didn't, all of our competitors fell down, right? So that to me is a very high level, one sentence on the math doesn't lie. That's a differentiator. But I'll hand it to Bob. He's got a lot more.
Yeah, and I was just going to say before Bob gets started, I noticed just working with you guys, over the last year, just the pedigrees of you guys makes a big difference going into that C-suite, right? We see that even when we're out selling, right? That that you're credible, you understand your business, you understand their business, right? What would you add, Bob, to what Mike just said?
Yeah, so Mike touched on one case that was an OTC LIBOR case. There's been a few other big ones out there. There was a CDS case that settled several years ago, and we challenged the claims administrator. They came back and had rejected our filings based on specific security types. We challenged them on behalf of 75 clients, and we ended up getting huge results. So for some of our clients, we were able to get them an additional $10 million over what they originally expected. One client, we were able to get them an additional $40 million because we went back, challenged, educated the claims administrator on why we felt this specific security type was entitled to participate in the class. So that's real money. There's another good example. A client moved to us prior to using us. They were using a custodian bank. When we onboard a new client that's moving from another provider, we'll go through, take all of their trading history and portfolio information, run it through our claims database, and prepare a report to share with the client to show what we've identified and to see if there are any gaps between what their previous provider filed for and what we've identified. And in this case, we identified, or in this example, we identified a number of cases that had either been missed or misfiled, and we corrected them, and we're able to get our clients $13.5 million in year one.
Wow.
So there's real money out there, and as Mike said, it's not just kind of file and forget it. It's file, follow up, make sure that we clearly understand all aspects of the case, as well as all the various security types that may be eligible, so we can make sure our clients are getting everything that's due to them.
Yeah, I mean, it sounds to me that the greatest hesitation can be and it's incorrect that this can negatively impact you're the hedge fund portfolio manager. This can negatively impact your relationship with that company because there's no good empirical or mathematical reason not to do this, right?
That's right. That's right.
Right. So I think it's like the softer stuff, right? I think.
Yep, it's true. And then there's different case types. There's the class actions that we've been talking about, and then there's antitrust. And antitrust is where, you're looking at interest rate rigging or currency rate manipulations. Those, you're not dealing in securities with a common identifier. You're not dealing with a corporate bond or a common stock. And so it's harder sometimes to identify the security types and to figure out if a client of yours actually traded, on that exchange or with that broker or counterparty. But we go that extra effort and find it. And that's why some of the examples we just gave are on the antitrust case side. 'Cause that's where we really kind of differentiate from others. Same on the internationals.
Yep. So let's shift to kind of the last area I want to cover with you guys is just kind of the marketplace, right? And I want to talk a little bit about the SEC from your perspective, their role, fair fund challenges. We talked in preparing for this about, a little bit about crypto and where'd the money go, and but I'm just kind of interested in your guys' views on kind of the SEC and the marketplace. I think first I'd want to just hear a little bit about that, and then maybe the second topic we can talk about is what I kind of maybe call allocator awareness, right? Like we talk about the hedge fund, the investor, right? But I'd like to talk about the SEC. I'd like to talk about allocator awareness. So let's start with the SEC and kind of their role, your view, whatever you're comfortable saying on that front.
Sure. So I'll start it off. So several months ago, I had lunch with a friend of mine, partner in a law firm, was explaining the business to him. And he'd heard from one or two of his clients that had undergone recent SEC exams that the SEC had actually added to their checklist a question around, do you have a class action filing process in place? I'm not sure if it's treated as a black mark if you don't, but I think what it means is the SEC is aware of this side of the business. They see the benefits that it can bring to hedge funds, but really ultimately to their investors. And Mike can touch on fiduciary awareness, when we get to that. But, I think they're now plugged into this and are aware that there is a lot of money out there and there's a process. And so they want to know, I'm assuming.
And you would think, right, it should be regarded by the SEC as a best practice.
Yes.
Right? I mean, that's what I would think, right?
I would argue for that too, and that just helps our marketing efforts. So.
right. So that's a very big step that will certainly helps your business. How about the fiduciary side, Mike? Your view on that?
Yeah, I think the fiduciary, as Bob mentioned, like the kind of prudent man, as a CFA, I always try to put that in there. The prudent man approach would be you're trying to get every dollar for your clients, right, in every facet, in every way. And so I think there is a kind of an unwritten fiduciary responsibility to look at this. I think that from the more that the regulators like the SEC are defining rules around new products. One of the things that we've been asked the question a lot: how do you deal in everything? Is there anything, if we deal with you, do we have to then carve out some other area? And the answer is no. We deal with everything. So when you get into some of the newer products, it could be SPACs, right? It could be crypto. It could be those types of things that are more emerging. It's when we think about new product expansion, every year we're doing that, and we're trying to figure out all the answers to the questions on these products. So to the extent there's regulation or talk of regulation or dialogue on crypto and SPACs, we're paying attention because at the end of the day, it's going to impact the cases. It's going to impact the results, and we need to be ready for that.
So my next question, guys, is the crypto world, right? Obviously, taking a beating, because of one bad actor, I think. But we have seen, I think, people be a little more hesitant, kind of maybe building infrastructure, getting ready, but maybe toe in the water, but things have kind of slowed down a little bit. Your thoughts on crypto and how it impacts kind of your world?
Yeah, I'll start. I think what we try to do is break it down into kind of its component parts, right? So one part is the data that we get, right? So every product's different, right? Equity and a future and a forward and FX is different. Crypto is going to be different. What are the key fields that we need? What's important, what's mandatory, what's not mandatory. So that whole schema is new with every product. So crypto falls into that, number
Yeah.
one. Identifying, and we have done that, who are the big holders on the fund admin side, or who handles the crypto space and the custody perspective, because those are people that we're going to want to know, right? Because we're going to be dealing with
Yeah.
them. I think the other side of it is, unlike the more traditional products where there's a funder, or there's the settling party, which is a firm. If there's a crypto settlement against a crypto firm, right? Well, that's one thing, right? And so unless there's they're bankrupt and there's no money there, that follows a similar path. I think the challenge with crypto is some of the suits that we've seen that have been put out there and are still pending are. The question becomes, where is the money? Like, who's producing the money? Because it's not as evident as just a equity holder name.
Yeah,
And
right.
that's the other challenge, is figuring out, because at the end of the day, we also have to discern for our clients, if there's a case that really is not going to result in any dollars, right? Whether it be that there's no dollars, it's not a defined party. We need to figure that out up front, so we're not challenging them to produce, to work with
Right.
them, where at the end of the rainbow there's nothing there. So I think it's the data quality and the importance of the components, which is a new product. Crypto is obviously one of them, but then it's what is the suit? Who is the defendant in the suit? And I
Yeah.
think my guess is that there'll be a kind of a fork in the road, where there'll be the more traditional, where it's one party, it's a firm, and that'll follow the path of, let's say, an equity case. And then you'll have where it's not a firm, it's not as evident, and I think we'll have to figure that path. That'll be a new path.
Yeah, which I think will quickly be, quickly I'll say, which might be interesting. People, when they hit that other fork in the road, still may want to get in line, not knowing, right, if there really ever will be a settlement, because nobody knows where the money is. I don't know, right? But it's interesting.
Yep.
Well,
Bob,
and you bring up
go ahead.
an interesting point on that, and one of the reasons why we're getting the data on a lag, but for as far back as we can, is that there are these cases that are pending. We'll know now. Obviously, if it's pending, we don't know if there'll be a settlement amount on what the class period is, but we'll be able to show a client, hey, if this settles, you likely have something because you have dollars in it or you held it. So it's very helpful for our clients to not only see what their settlements are that they're engaged in or we're engaged in for them, but also the pending side, because on average it's about 1 out of every 2 pending cases settle and the other one dismisses, right? So if we're constantly showing you've got 30 pending cases, you don't know which one of those.
No, but you're going to get 15 of them.
You have something, right?
Right.
And that's helpful for clients as they think about the pipeline of potential revenue.
Yeah, no, that's a good way to look at it. Bob, anything you want to add to crypto?
Not on crypto. I think Mike did a very good job covering it.
Thank you guys for joining me. I learned a lot today, and the whole point of this was to make sure our audience really knows about you guys and what you do. And I think you've got a terrific business, and you've really been a great client of ours. And we wish you guys just continued great success. So thank you for making time for us today.
Thanks, George. Thanks for having us. Great to see you.
So I want to thank Mike and Bob again for joining me. I thought it was a terrific conversation, really interesting firm, and really not a lot of downside to engaging them. So hopefully that was very helpful to our listeners. Lastly, I always like to briefly recap our league tables, and that's where we look at market share for some of the major providers to the private markets industry. So let me start with admins, and all of my comments are year over year. So over the last year, assets went down about 5.6%. That are serviced by administrators, and then we look at the growth. So in admins 1 through 5, they were down about 7.5%. So down quite a bit more, 2% more than the market. Interestingly enough, admins ranked 6 to 10 were up 5%, and admins 11 to 25 were about 1%, pretty flat, right? So again, a trend we've seen for some time is that top 5 not pacing with the market. On the custodian front, assets administered by custodians were up about 3%. But when you start to look at that breakdown, custodians 1 through 10 were down about 2%, and custodians 11 to 25 were up about 5.25%. So down market outperformed the market. When I go to primes, and with primes we look more at funds, and we saw growth in funds be pretty significant, 12%. We saw prime brokers 1 through 10 grow around 3%. Prime brokers 11 to 25 grow around 5.25%. But prime brokers 25 plus grew about 10.5%. So 25 plus are the ones that kept pace with the market. And then lastly, auditors. Again, similar to administrators, we saw asset growth down about 5.6%. And then very interesting, we saw auditors 1 through 4, so the big 4 down about 5%. Auditors 5 to 10 up almost 20%. So almost 4 times, more than that. The market was down 5%. So up 20%. And then we saw auditors 11 to 25 up 8%. So the clearest of them all, where we saw distribution of assets and decisions made beyond the auditors 1 through 4 be significantly greater. So people going more to the next tier of auditor, that middle market. So anyway, interesting guest today, and league table is always interesting. I want to thank you all for joining me today for our 24th episode, our 2-year anniversary, and we will see you again in March. Thank you very much.